We're back in your life, and today's episode is a special webinar edition. We've got Jim Dodd from Property CEO, the good-looking Matthew Harris, Managing Director at Lighthouse Financial. They're talking all things property flipping, how to do it, is it a good idea for you, the right tax strategies. So enjoy the episode.
All right, everyone, welcome in. I can see there's a number of you coming in. Jim, how are you tonight?
I am wonderful, thank you, Matthew. How are you doing yourself?
I'm doing really well. I love a good webinar. Just as a bit of a preface to the start, I'm Matt Harris, I'm Managing Director at Lighthouse, and I'm joined by Jim Dodd, who is the co-founder, and you managing the CEO?
Yep, CEO,
Yep,
property
co
CEO.
so the CEO of Property CEO. Um, I'll do a little bit of a sort of blurb about us when I get to the slides, but maybe Jim, you can tell everyone who doesn't already know what you're all about before we get going.
Yeah, awesome. Well, great to have everyone here, and thank you for taking the time out of your evening. Yes, I am Jim Dodd. I'm the co-founder at Property CEO. What we do is we provide education around property trading. And so what I'll be talking to you guys about today is whether or not property trading actually makes sense, how it sort of stacks up when you're thinking about your property strategies, whether or not it's something to consider in your strategy when you're thinking about your long-term investments, that sort of thing, and give you some actionable things to take away from this so that you can trial some things and actually test out some things in the real world. So I like to keep things practical and have some sort of action items that come out of things. So I will be challenging you with going away and doing something with the knowledge that you learn this evening. And yeah, I mean, I'm here as a resource throughout this as well, and we'll have an opportunity to check in with our team if you'd like to learn more throughout this session as well.
Yeah, I really like that. It's really important to take some action after things like that, and always say people who don't take the first step can't take the second, and in property, it's really true. So you guys want to look at the polls that we've got for you. Will we see further reductions of the OCR next year? And do you think the property market will go up in the next 12 months? My job in this webinar, apart from to go through some slides as well, is I'm going to kind of be the check and balance. So I've had a pretty long history of property investment. To be honest, it's mostly been on the buy and hold side. I have done some trades. I've also built some townhouses, but we've worked with a huge amount of clients over the year who have done trades. So I like to think I understand both sides pretty well. So I'm going to try sort of show round out how a trading strategy and or a buy and hold strategy and moving between them can be possible. And we'll talk a little bit about tax as well, and take it from there. So Emily, I think probably we can sort of get onto it with questions. Just for people watching, put them in the chat, put them in the questions. We will either stop, depending if it's when Jim's talking, he'll either stop and answer them, or we'll do it all at the end. But please do ask us some questions. Can you see the poll results, Jim?
Yes.
Yeah, do you want to give us those?
So we have, will we see further reductions of the OCR next year? And it is a pretty even split. Pretty even split.
Yeah. What do you think, Jim?
Basically, I'm in the split of, I don't know. It's, I mean, it would be nice to see them come down further because we have not seen a significant shift in the market. So if that is the lever that is going to do something about it, then we would hope that it's going to drop even further. Your thoughts, Matthew?
Yeah, look, I think we'll get 0.25 and then we'll be done. I really hope we get that. I think the interest rates need to come down a little bit further, but I can definitely see how we've got quite an even split here because there's a bit of uncertainty when you ask people about it. And even I don't think the RBNZ have even decided yet, so we'll see. What about number two? That one's a bit better
So
answer,
number
isn't it?
two, yeah, number two is an interesting one because it doesn't really reflect what number one's answers were. So, do you think the property market will go up in the next 12 months? And overwhelmingly, the answer is yes. There's been a small percentage of you saying no, but that's interesting when you think about the levers that are out there that may be pulled. It's looking like, yeah, most of us think it is going to go up.
Yeah, and look, I'm definitely in the yes camp. I think anytime you have a series of interest rate downgrades or reduction in OCR, you automatically get an increase in people who can borrow and want to borrow because the cost of that money is far more palatable than it's been. So good results. Thanks everyone. So we'll get on with the webinar now. And I thought that's quite a good way to start it actually, because some of the slides we're going to cover are what we're doing. So just quickly a little bit about Lighthouse. Our mission is to secure Kiwis' financial future. We do that through education, action, and financial freedom. Pretty much what we believe aligns really well with the kind of thing that Property CEO delivers. So we believe financial literacy plus action equals financial success. Buy long-term assets. So long-term assets in short are pretty much property and equities. And then the third thing we believe is that compounding returns the most powerful force in the financial universe. So that's what we believe. Property really, really well aligns with what we do here at Lighthouse. Bit of a vanity slide that Em's chucked in there. 12,000 clients, 95% of attendees of these types of webinars, and we run lots of them for all sorts of different topics, would recommend to friends and family. We didn't like the other 5% anyway. And some of the company, some of the companies that we've worked with, obviously some big names there. This very, very good vanity slide. Thank you. Oh. There we go. Okay, disclaimer, I have to say this so the lawyers don't get me. Neither Jim or myself will be providing personalized advice. We're talking in general terms. If you want to discuss anything at all that we talked about tonight, there's some booking links at the end of the webinar. Please book in, and we'd be more than happy to have a chat. There's no obligation. You can just have a chat to us, and we'll give you the information. That's how it works. So we're going to talk about the market outlook. I'll probably just cover that quickly at the start, and we've kind of already just covered it. Flipping fundamentals, buy and hold blueprint. We'll talk about some tax. We'll talk about a little bit of real world insights. But really, I think where you'll get a lot of value is the Q&A. That's where you get to ask some questions, and we'll do our best to answer them. Cool. So quickly, we just talked about it. Obviously, interest rates affect the property market, and it's a pretty simple equation. The cost of money, if when the cost of money is higher, people borrow less of it because they can't service it and or the deals don't make sense. When the cost of money is lower, people tend to borrow more of it. Our markets, whether they be property markets or financial markets, are inflationary by nature. And what that means is they typically go up over time. They might go down in the middle, but if you look between 2 points, they go up, and that's because they're inflationary. So when interest rates come down, obviously we see higher affordability, more buyers out of the market. At the moment, in our mortgage team, we're seeing a huge amount of activity that indicates that this is true. And what will naturally happen when more buyers hit the market, that market will start to recover. So I fully expect to see property prices start to increase. I think they already are starting to increase, and my personal opinion is that we've got probably about 3 bright years ahead of us, which actually seems like quite a short time given, we probably just had 3 horrible years. I don't know, what do you think, Jim?
Yeah, I think you're probably right. It's certainly due for it. It's certainly due for a shift that is meaningful. How long that shift is will be interesting. But yeah, let's hope for at least a 3 year run.
3 bright years and a little bit more. I always laugh about property and actually all markets. When the property market's up no one ever thinks it's going to go down again. And when it's down, no one ever thinks it's going to go up again, and neither is true. So I think it's really important when you go into any type of undertaking of investments is that markets will go up and down. But I think definitely with property trading, um, does a rising market help? I don't know. I'll let you tell us in the next slides.
All good. Beautiful. All right. So, before we do start with the flipping fundamentals as well, I want to set a frame in the way in which I think about property trading versus any other type of property strategy. So I'd encourage you, if you've got a pen and paper handy, or just imagine you're doing it if you don't have a pen and paper handy, just imagine or actually draw a triangle in the middle of your page. And at the bottom left-hand corner, if you write there, make, so make in the bottom left-hand corner, in the top point, just write in there manage. And then on the right-hand side of the triangle, just write in there multiply. So this is the way I think about the approach with money. And it's thinking, well, first I need to make money. So that's the bottom left-hand corner. Then I have to manage it, which is the top. And then I need to consider multiplying it. So when I think about property trading falls under the make section. Property investing falls under the multiply section. And so I just want to set that frame before we start on this journey, because it's important to understand why you do a certain strategy, where it falls into place. Okay, so flipping, in my opinion, is not a long-term investment strategy. It is a business, and it should be treated like a business. So what does that mean? Well, it's focusing on making money. It's focusing on generating income and revenue. So with that said, hopefully that makes sense, team, and hopefully that helps with the way that you're thinking about it. It's not an either or. It's a, is this the thing that would make sense for what I'm looking to do now? Quite often what I see is that there is skills and resources and experience that property investors have that go underutilized. Meaning, if you were to utilize those skills and resources that you have and apply that to property trading, quite often you can generate far more income than you otherwise could, either in your day job or even with a buy and hold, like just relying on the rental income. So we'll talk a little bit more about how that looks as well. So in terms of your strategy when it comes to flipping, so let's assume now you've already gone, yes, I want to try this flipping thing. All right. Really, really simply, you need to be buying well. Okay. So it starts with if you are not aware of what the market is doing and you buy at the peak of the market or even in your micro market, and this is where I sort of have a slightly different approach to the poll that you guys just did earlier, because we see micro markets, meaning through this entire downturn of the market, we've seen over and over again the opportunity in different locations where markets are still hot. Now, what does that mean? It means people are still buying. So the first fundamental is knowing what is your market doing? What are they buying? Because that's what then you can focus on. You're focusing on what market already exists, and you can go, great, let's go find a property with problems. Okay, so number one is finding a property with problems in a market that has buyers. So what does that mean? Well, it's something that you can add value to. Right? It's a problem that vendor or the seller just doesn't know how to solve or doesn't want to solve or isn't in a position to do so. And so they're looking to offload for whatever reason. And the way I sort of joke about it is if I'm, out for a walk with the dog or going for a walk with family, if there is a property that my wife says there's no way I'm going near that property, I get excited about that property. Okay, so that's the property where I go, okay, that's got potential. We could add value to it. So that's the first thing, is just paying attention to, what is an opportunity. Before even starting to look at properties, identify your market. That is the number one thing, and I cannot stress that enough. People make so many errors just on that assumption that just because it needs work, it's going to be a deal. That is not the case. So the certain things that we look for in terms of adding value could be the layout is wrong. Okay, it could be just the cosmetics need to be upgraded. So things like carpets, paint, landscaping is a really good one. So again, when you're out on a bike ride or something and you see really poor landscaping, or just long grass everywhere, trees overgrown, vines going through everywhere, that's a good indication that it's completely neglected and there's value that you can add. And the beauty of that is there's massive, and I mean massive, perceived value that you can add. So relative to what it actually costs to, get rid of the landscaping that is causing the issue, for example, is low compared to the uplift that that can provide. The next one is identifying your streets, your areas. Okay, so paying attention to your local market is always what I recommend. Many people come to us and ask, can I focus on some of these smaller towns? All right, particularly people that come to us from Auckland are like, oh, should we be focusing on Wanganui or should we focus on Levin? And I'm like, do you know those markets? That's the first thing I'm going to ask. Do you know them? Do you really know them? Most likely the answer is no, right? So why would you focus on a market that you have no clue on what the good streets are or what the bad streets are? Okay, a lot of danger in that. And I say that from experience. I have purchased on streets that are riddled with gangs and not realized. Okay. Now that makes a significant difference when it comes to selling the property on the other side. So knowing your suburbs, knowing your areas, knowing your streets is very, very important. In some places, in fact, the side of the street matters, which is quite crazy. Okay, but these are the things that you sort of you actually have to pay attention to if you want to do it properly. The other thing is the timeline will can kill a deal. Meaning, the longer you stay in a deal, the more it eats away at your profits. So you want to pay attention to what sort of work actually is required. Am I going to require consents? Is there a flood zone here? Is there other issues that are creating the reason that it wants to, the vendor wants to get rid of the property? If that is the case, just work out what would it cost for an extra, let's say, 3 to 6 months that you have to hold that property, and does the return on that time frame actually work out? Okay. So, Matt, any questions
I love it. Location,
on what I've
location,
covered so far?
location. There's
Absolutely.
never a truer thing in property, and the Wanganui, especially, you have to be quite careful with the gangs. I guess the only thing, maybe you can run through some of the places where you can buy below market. In Auckland, for example, yeah, I don't know how much time you've spent in Auckland, but what I love about Auckland suburbs is no matter what suburb you go to, even the very ritzy ones, there's always rundown houses with deferred maintenance issues. We have lots of leaky buildings. Deceased estates is obviously an area, but one thing I think people often overlook is family.
Hmm.
Quite often, a family member will have a property that they'll sell you, potentially under market value, or potentially if it's a really hot market, instead of having to go to auction to win it, you might be able to get it. So I think that's quite a good place to try buy well.
Absolutely. And that's actually one of the things we talk to our members about is, once you're like serious about doing something in the trading game, you want to let people know. The sooner you let people know, the sooner other people are looking for you as well. And that's
Yeah.
where things like, family members say, hey, actually, that property we've got in wherever it is that we've sort of let go of, and we don't want to have to deal with it. Do you want to take that off our hands? And that happens so often. It's not
Yeah.
even funny. But I would actually still caution, even when those opportunities come up, that you're still checking the market. Because whilst it might be, under market value, does not guarantee that you're going to be able to sell it at the other end. So same thing, you might go put a whole bunch of money into it and then realize at the end of it there was no buyer, meaning there was no demand in that area. So that's the thing, is that location, is knowing that there is a market there. So some of you are probably wondering, well, how do you know that? Well, you do what we call market research. That's understanding, what properties are actually selling. You can ask agents for that information, or you can just Google it. All right. So free sites like realestate.co.nz, homes.co.nz, they'll tell you what properties have sold in certain areas, and that gives you an indication of what is actually selling, how much they're selling for, and then when you are looking at properties, you can go, okay, well, I'm getting it for $200,000-300,000 less than what the market is, and it might cost me 50,000 to do it up. So yeah, hopefully that's in terms of just your initial flash in the pan understanding, gives you guys an understanding.
And before you move to the next slide, there's just one other thing that really resonated with me that you said, and that is that property flipping is a business. And I love that. I think that anyone who enters into the property market, even on the buy and hold side, should be treating it like it's a business. So making business-like decisions, keeping on top of your debt, speed to market, for example, being aware of how long it would take to kill your profit, and all those things. If you approach something with a professional mindset, you're always going to get further.
Yes. Yeah. So we've briefly spoken about what I call your pipeline phase. So this is the phase in which you start getting some opportunities moving. Now we're talking about the actual work. All right. So the renovation phase, or the delivering on what you have said you're going to do with the property. So there's some things that can really work well throughout your next phase, the renovation phase. And that happens when you, again, strategically think about it from a business mindset. So that's looking at things like what is the overall scope of the renovations that we're looking to do. So having a clear plan on what you're actually wanting to do before you even settle on the property. Okay, so many people make a mistake here where they buy a property, they then get the keys, and then they start planning. All right, now why that becomes an issue is because, one, you may have bought a dud because you didn't do your planning first. Two, you're already behind, okay, because you should have boots on the ground on day one. So the second you get the keys, the goal is to have your team there the same day you get the keys, okay? So planning is a huge part of that. That's scoping out what it is that you need to do in terms of work. Then it's identifying what resources you need for that scope. So there's two main aspects. One is the labor component. So what specialist trades are you going to require? What labor are you going to require? Just, standard like trade labor outside of specialists. And then what materials? Once you understand what those two things are, we can now schedule things in. So it's a very straightforward initial phase prior to getting the keys. Okay, so the key thing there is get that done before you get the keys. Once you got the keys, you're into the project, and it's about keeping your finger on the pulse, making sure everything that you had planned is now being measured. So as you're starting to do the process, many people think I'm just going to DIY as much as I possibly can because I'm going to save money. I believe that in the beginning as well. Okay, so if you don't know my background, I used to be an electrician. I then learned how to plumb. I then learned how to build. I learned how to tile. I learned how to plaster, and I learned how to paint. I wish I hadn't. Okay. So why I say that is it's great for the insights and understanding how things work, but it's terrible for your life. Basically, it's terrible for your relationships. It's terrible for your family if you're always out there doing everything all the time. Okay, because I would spend weekends, evenings, and work hours working on these properties, and it got to a point where I figured there's actually got to be a better way. Again, when I thought about it through a business mindset, I figured, what if I got the experts in? Okay, what would that look like? Now, again, if in the mind at the time I was thinking, well, that's going to cost me. Okay. What I didn't realize is the projects that I did DIY, I didn't factor in my labor. And so what looked good on paper, when I factored in my labor, the deal actually didn't stack up that well at all. And so I was masking the fact that it wasn't actually as good a deal because I was doing it myself. So some of you have gone through that process yourselves where you're like, yeah, I'm saving money. But you should actually be factoring that into your costs to see whether or not that deal stacked up. Why? Because you want to learn from it. You want to learn from what worked, what didn't work, so you can apply it to future opportunities. So if you continue to do that, you'll continue to underprice the property deals. So that's just a nerdy way to think about it, but it's very important to think about it that way. The flip side of it is that you actually get a better quality finish as well. So me, when I was learning the tiling process, that tiling was terrible compared to a professional tiler. So the quality of the work that you put out is going to vastly improve when you get the experts in, you get the pros in to do it. Not only that, you get your time back. Okay, so this is a key thing, and a big part of what our members start to realize over time. When you not only treat it like a business, but be a business owner, which is different to a business operator. When you're a business owner, you start to think, well, how do I get leverage over things? Okay, so what are those things I can get leverage over? Well, I can get leverage over other people's time. Okay, so I call it OPT, OPK, and OPM. OPT is other people's time. OPK is other people's knowledge, right? That's bringing in experts. And then OPM is other people's money. So 3 layers of leverage, which is how you can scale, but it's also how you get your time back. Okay. Now, when you do that, it's really important that as you're running the numbers on your projects, you're actually allowing for overruns. So that's where we say you want to add somewhere between a 10 and 15% contingency. Again, as you start to get volume, you see patterns, you see, whether or not that contingency matches up or if you need to tighten things up. Now, going back to what we spoke about, which was the, understanding who your market is, that also teaches you what to do with your renovations. So it's going to guide you when you know who your buyer is on what to actually put in the property itself, what features, what functions are suitable for who your ideal buyer is. Okay, so if we're always thinking through their minds, it makes the design side of things a lot easier. And in fact, if you bring in a designer, that's one of the things they're going to ask you. Who is this for? Who's the end buyer here? Who's actually going to be living in this property? So that's a key thing that we focus on when it comes to the renovations. It's guided by who we're providing the property for. As I mentioned earlier, we're tracking, measuring everything. You're going to have your budget that you've allowed for the project, and then you're going to have your actuals. So the way in which you can, almost back of the napkin, but I would suggest a spreadsheet or some sort of tracking tool, is you're identifying, week by week, based on what trades you're bringing in, how much you're anticipating to spend, and then how much you're actually spending. Another big mistake I see happen is people wait to the very end of the project to go, oh my God, we overspent, or oh my God, we blew out the budget. Okay, now, in fact, you can find out if that's going to happen far earlier than that. Why do you want to do that? So you can do something about it. All right, if you can catch it in the moment, you can go, all right, maybe we can find some other ways to reduce costs over here, over there, somewhere else, or talk to your tradespeople about what's going on and see what ideas they come up with. You'd be surprised at what incredible ideas come out of just asking the question, hey, is there a better way of doing this? We had one situation where a plumber quoted us $20,000 to fix a runoff drainage issue, and the next one quoted us $25,000, and then we asked one of them, "Is there a better way of doing it?" And they said, "Oh yeah, we would just do it like this." And we said, "Well, how much is that going to cost?" And he said about $800. Oh, so what they were quoting was what we said we thought we needed. But then when they heard us say, hey, is there a better way? They were like, yeah, there is a better way. Okay, so just be mindful of who it is that you're working for and just question, is there a better way of doing things? Because people will give you what you ask for. Quite often they won't talk about other solutions that could be far better than the one that's right in front of you.
That
So
was great.
simply,
Sorry, just to jump in there, Jim. I
yeah,
really liked a couple of things in there. Um, the leverage one is always really interesting. People always think when they think of leverage, they just immediately go, well, money from the bank. But leverage is actually everything in your ecosystem that you can pull to get a result. And your little acronyms, other people's money, OPM. I ran out before when because you got your hat on, so I put my need money for property hat on. Never a truer word in property. You can't do it without money. And just one final question, actually, which the listeners might like to have you answer. Do you sometimes, as part of your strategies, try and negotiate early access to these properties, or is that something that you avoid?
yeah, yeah, for sure. So there's the opportunity to reduce the time frame in which you're holding the property, and in some cases, if like the ultimate is if you can have it renovated and sold before you even purchase it. And so
Mm,
that's the opportunity to get early access. And that's a simple clause that you can put into the sale and purchase agreement. Often it does get pushback because the vendors often are like, why would I let you in my property when you don't own it?
yeah.
But that's a valid objection. We do have ways of overcoming that objection. You just line up what it is that they're going to be thinking and give them a solution to that. So in that case, you have contract works insurance to cover anything. They will already have insurance in place themselves, and so they are covered for general repairs or issues that occur anyway. So if you help the vendor understand the dynamics and what could go wrong, and then what the solution is to what could go wrong, quite often you can get that across the line, and that makes a massive difference again, because that could be 10, 20, $30,000 in holding costs potentially if you can get early
Mm,
access and delayed settlement.
yeah. Yeah. If anyone has any questions about any of that, chuck it in the Q&A and we'll do it at the end.
Beautiful. So yeah, this slide here, team, is just giving you a basic rundown of what we're covering here. So starting with the finding phase, really, really focused on the micro market, so understanding who your buyer is. Then we're in the analyze phase, so that's assessing all your numbers, doing your due diligence, figuring out if things actually stack up. Then we're into the funding stage. So this is identifying how are we going to fund the project. And it's not only the purchase, but it's also the renovations and holding costs as well. So you've got to factor in all of the components when it comes to your funding. Then we're into the phase of actually fixing up the property. And then we're into the sales and marketing, which is actually flipping the property. Just quickly on the sales and marketing, one of the frameworks that I like to use is TLC. So you can write that down. TLC stands for traffic leads conversion. And so we're paying attention to what's going on with the traffic when we're coming to sell the property. So what does that mean? Well, it's eyeballs. What eyeballs are you getting on the property? What is your marketing doing to get more eyeballs? That's the key focus. Often, what we do is we just go, right, I'm ready to sell my property. I'm just going to go give it to an agent, okay, and then hope for the best. Um, that works for the most part, especially in a hot market, okay, because generally the market's just doing the agent's work anyway. In a flat market like we're in now and what we've experienced over the last few years, you want to be paying attention to what your agent's actually doing. So this is why I use that framework TLC, traffic leads conversions. The traffic part of it is just seeing where are they putting your ads. Okay, so if they're purchasing the basic level of listing on Trade Me and that's it, well, you're probably going to end up on page 5 of all the listings. Okay, and so the amount of eyeballs you're going to get on your property is going to be limited. And so we want to pay attention to what sort of campaigns are we doing in trying to get as many eyeballs as we possibly can on the property. Then we're into leads, which is your ability to have people show up and check out the property. So what I'm looking at there is how many people are coming to open homes, how many people are showing up to private viewings, how many people are actually checking out the property. Okay, so we've got eyeballs, that is basically views or clicks or anything on the adverts. We've then got the viewings, which is identifying what leads are coming in. Think of leads as the moment that you capture the information. So the moment that person walks into the door, you're going to fill out a registration form. That's the leads part. So we want to be filling that booklet or your list full of leads. And then you're in the conversion phase, which is how many offers are you actually getting on the property, or how many registrations are you getting at auction. Paying attention to all three of those things is incredibly important when it comes to trading property, because it's your responsibility as the owner to drive those results. The agent is just going to do what they've always done, and that's typically just let their process do the work. And often those processes are broken. Often they become complacent, meaning they skip things or miss things. One of the biggest things we notice is the follow-up. The follow-up is generally abysmal. And many of you have probably experienced that when you've gone and checked out properties where you're like, that agent didn't even call me the next day, right? Or that agent called me, I didn't pick up the phone, and then they never tried again. Okay, now that is terrible follow-up game, and so you want to be paying attention to that when you come to selling the properties.
Hey, there was one quick question, Jim, that you might like to answer as we go, which was from Irina. I hope I'm saying that right. She asked, would she or he asked, would we market the property ourselves as well as the agent? Question mark.
Uh, Professionally, yes. Beginning, no. Okay, because if you were to do it at the beginning, you wouldn't, without the skills or insights or understanding of what marketing really means and what channels and how to run campaigns and all of that, doing it yourself won't make sense. It's just having an awareness of, are the agents doing a good job? Okay, and that framework that I just gave you is just very high level, and it's a very good way to think about it, because you just think, are we getting enough eyeballs? And you can literally ask your agent that, are we getting enough eyeballs? And they'll go, yeah, we've had this, this, and this. And you go, great. From those eyeballs, how many leads have we got? How many bookings? How many people are showing up to open homes? And they'll say, yeah, that's looking really good. We got this, this, and this. Compared to what? Okay, this is a great question I like to ask. Compared to what? What are we comparing that to? So, for example, if they're comparing it to a property that has zero interest, and they're like, yep, it's looking really great, well, that's a very low bar that they're comparing it to, versus a property that's got great interest, and this property has got even more interest. Oh my God, that's the market. That's what we're after. Okay, so I always ask them, compared to what? What are we comparing the numbers when you tell me it's great, compared to what? Right? Or if you're saying, oh, it's not a good, it wasn't a good week, compared to what? Okay, so for example, because we've got members in regional towns, which typically have a lot lower numbers than some of our cities. We had one, just to give you an example how vast the differences are. In some of the regional towns, we might have 5 groups on a good week show up to an open home. In some of our strong city markets, we've had up to 160 groups come through. Right? Wild difference. So it's always understanding compared to what? What are we comparing these numbers to? And then the conversions part is just checking in. Yeah, who are actually interested in putting pen to paper? Who's registering for the auction? Who's making offers? All right, so hopefully that answers the question.
Yep, I think you got it.
In terms of other things that I see, it's where people don't treat it like a business where they mostly go wrong. Okay, it's the DIY. I'll figure it out myself. It can't be that hard. I know a builder. It's these sorts of things where people really get stuck, and they'll keep repeating the same processes over and over again, and just hit the same wall that I hit when I first started my journey, which was surely the next one's going to be a little bit better. It's not until you really remove that lens of DIY and put a whole new lens of I want to be a business owner, because like I say, this falls under the make category when it comes to money. Treat it like a business. Okay, when you start to operate it like a business, where you go, who is the right person to be doing this particular part of it? Okay, so it's like saying, I'm gonna do all of my accounting myself, even though I don't have that background. I'm gonna figure out the mortgages myself. That doesn't make sense. You go and talk to the likes of Lighthouse, who are professionals to take care of that stuff. Okay, so same thing with your tradespeople. Get the pros in, figure out your numbers, because if you can't make the numbers work with the pros in place, well, then the deal's not that good. Okay, then you've got to go back to the fundamentals of what makes a good deal, identify your market first, find out the opportunities. There's two main things that I look for: high motivation and high profit potential. Now, what is high motivation? That's what is the reasons that the person is selling the property? What is the urgency behind it? What are they afraid of having happen? Okay, because as we talked about earlier, is quite often this is a problem I don't want to have to deal with. Okay, so we get a lot of off-market deals that come through. Why do they come through? It's because people don't want to make it public that they've got this crappy house doing who knows what, right? And so they don't want to go through an agent. They don't want to have to deal with open homes. They don't want to have, they don't even want to think about the property anymore. And so when you really appreciate that, you can go, right, let's identify those properties. Let's go and figure out what can we do to help that person? How can we help take that off their hands and solve the problem? And let's rejuvenate that property and put it back to the market so that someone can enjoy it. So that's really like my philosophy behind it, Matt, is just we're finding things that need problems solved, and we go and solve the problems.
Great amount of satisfaction in that as well. If anyone on the call has on the webinar has ever renovated a house either to live in or to sell, when you start with something that's a bit run down and you transform it and you get this end product that is a lot better, it improves the neighborhood, it improves the lifestyle of the people that live there. So it is a great business to be in that respect. And I certainly agree with you. I myself have done everything on your list except tiling, which I just never had enough skill for. Plastering by far the worst job, followed by sanding floors.
Yeah. I used to dream about the tiny little bubbles that I'd create with the plastering. I hated it. There's not too much I need to say about this, guys. It's fundamentally what I was saying earlier is make, manage, multiply. All right. So flipping, great way to make money. Holding, best way to multiply money. All right.
Hey, James here. A quick pause in today's episode. We all know New Year's resolutions are a waste of time without a good plan. That's why Mike and I are hosting a financial planning webinar to help you build a clear, practical plan for 2026. We'll cover how to set smart goals, make clear decisions with your budget, get your cash flow sorted, and make smarter investment decisions, and just really keep everything on track. It's on Wednesday, the 4th of February at 6 p.m. The link to register now is in the show notes. Now, back to the episode.
I really enjoyed that, Jim. Can you get us the next slide? So what I'll try and do is I really enjoyed your triangle as well. So this is very much in the quadrant two, I think, the multiply section. When you look at buy and hold a property, basically when you look at being a property investor, there is only two sides of the coin. So there's buy and hold. So that's someone who buys and holds for the long term, and you've got trader, and that's someone who buys and sells in the short term. When I look at buy and hold is about adding value, buying well. It's about cash flow. It's about capital growth over time. And when I look at trading, it's all those same things, but it's more akin to a business in that it's active. Um, I really like the concept of growing wealth through property. And one of the mantras that we went through at the beginning, obviously, was buy long-term assets. So buy and hold investment really does suit this. The other thing, which is really important to remember, is that the market by nature is inflationary. So over time, property does go up. In New Zealand, over the last 30 years, house prices have gone up on an annualized average basis of between 6 and 7%. This takes into account the various downturns that we've had. The earliest downturn I was involved in was the GFC in 2008, but there were definitely downturns prior to that. Um, and then we had some cracker years. There was one year where property annualized went up about 9%. So this is pretty important to bear that in mind. When you buy long-term assets, they will go up over time. When we look at when I look at property investment on the buy and hold side, I actually have a little saying because I really liked some of your little acronyms and your triangle, which I might steal for some of my future uh, presentations. As I call buy and hold investment, I describe it as incremental gain over time. So at the very first place that you can make a gain, and it's the very same in buy and hold as for trading, it is buying well. There are many places that you can buy well. You've covered some of them, but deceased estates, deferred maintenance, family members, if you're brave, leaky homes, even certain markets. So the Christchurch earthquakes, for example, created the as is, where is market, which is an opportunity to buy well. There's lots of different ways to do it. So first thing is buy well. Second part of the equation is add value. Good property investors, in my mind, always add value. I very much subscribe to the less is more approach. So one of your slides you mentioned, do what the market wants, not what you want. I think that's hugely important. Property people uh, do have a habit of trying to add the value in the way they would want it to be. It doesn't have to be like your house. Um, it doesn't have to be something that you would live in. It has to add value, not cost too much, and suit the environment that it's in. So painting, gardens, I really love that one because it's easy to do and adds a lot of value. Maybe curtains and blinds, but don't rip out the kitchen if the kitchen's fine, but you just don't like the color of it. So you got buy well, add value. Then we wait for the interest, the mortgage to go down. So P&I mortgage is a table mortgage, which is over time the amount of the loan will reduce, as opposed to interest only, which you might do with a trade. So that's going down. We wait for rents to go up. So over time, rents will increase because we have an inflationary market. Everything goes up in cost over time. And I don't have to tell anyone on this call, everything you buy today is more expensive than it was a year ago, and it goes on and on. And then the final thing is capital growth. So this capital growth rate will apply and it will go up and up over time. Sometimes it starts really slowly, especially if you start in a down market. There'll be times when it runs really fast, but over a long period of time, the property value will go up. So you add all those things together, and your incremental gain cycle is what makes you money in a buy and hold environment. The more properties you have in a buy and hold an incremental gain cycle, the bigger that gain will be over time. And there's just a couple other things which I think really important in it that people don't realize. And that is when you borrow money from the bank, that is not inflation adjusted. So you actually have a huge win when you borrow money from the bank, especially as most property investment loans are over a 20 to 30 year time period. So you get to pay that loan back with inflation dollars that aren't adjusted. So there's a lot of little wins in there. Um, some people then go to me, oh, Matt, I love trading because I make money. Um, yeah, me too. And the government loves trading because you make money and pay tax. Uh, the thing about a buy and hold investment is that, and we'll cover this when we get to the tax, is that it is virtually untaxed over time compared to trading. Um, but the other thing is they go, oh, well, I'm making a loss, I have to top it up. How will I ever get ahead? You've got to remember that the how property how your gain in property on a buy and hold side is calculated over time is um, capital growth rate plus or minus cash flow less inflation. So you've got to take it into account in totality, and that's why you hear people who will buy very expensive properties. They might burn, call it $1,000 a month or $1,500 a month on the interest cost, but the capital growth rate, maybe it's a $2 million property, the capital growth rate far outstrips that. So you've got to take that into account. And then the other part in here, and this is possibly a shameless plug for the mortgage team, but I am wearing a need money for property hat. A lot of people don't understand where they can get the money to begin from. And the same can be applied for property trading as well. A lot of people already have that money sitting in their own home. So equity is basically the difference between the value in your property and what it's worth. That's sorry, the value of your property and what the mortgage amount is. Usable equity is the difference between the value in your property, what your mortgage is, and what the bank loan to value ratio is. I won't get too into it. Loan to value ratios go up and down, but generally for an owner-occupied property, you can borrow 90%. For an investment, you can borrow 70%, for example. So if you want to, at the end of all this, you go, shit, I'm quite interested in trading or I'm quite interested in being a buy and hold investor and you don't know where to get the money, book in a call with one of our mortgage brokers because they can do the calculations on your home, what funds that you could borrow from that to go and go and kickstart your property trading or buy and hold activity. Cool. Anything to add on any of that, Jim, before I go on to the super exciting tax part?
Yeah, I mean, it's just there's so many benefits. It's really worth, like, if you're not aware of how it plays out over the long term, particularly how your mortgage shifts over, that first sort of 17-year period, when you understand the dynamics and understand how what you mentioned about the not adjusted for inflation, like how
Mm.
much impact that has, it's remarkable. And that's where, if you're considering other types of investments outside of property, you've really got to weigh that up and go, well, there's not many things that you can do that actually compare.
Yeah, and that's actually a really important point that I didn't make. One of the things when you're dealing with buying assets that makes property investment on the buy and hold side so attractive is actually the leverage part of it. So I am this time talking about leverage in cash terms. When you buy an investment property, aside from that inflation adjusted part, the bank's going to give you 70 to 80% of the money. But you are going to keep 100% of the gains. So the rate of return is exponentially higher on an investment property than, say for example, you have $100,000 of capital to deploy towards your future wealth creation. You can either buy $100,000 in an exchange traded fund, that might grow at 7% a year, or you can put a 10% down deposit down on or $1 million property, for example. That same property will grow at maybe 5 to 6%, but it's 5 to 6% of $1 million, not 7% of $100,000. So that was it's pretty important. And I think you know what the best thing in the world that's happened to us in recent years, Jim? Chat GPT. Anytime I want to work this stuff out, just go and open your chat GPT, chuck in your table mortgage, um, chuck in the value of your property, give it some parameters, say you want 5% a year, and and hit the button, and you'll be showing the future. And when you start to understand compounding returns and how powerful they are in terms of how much dollars you have in that cycle, and then also how much you reduce your debt going the opposite way, you'll think about things really differently.
And read it back to me like I'm a 5-year-old. Best thing
Yeah,
about ChatGPT.
yeah, exactly. Make sure you set the parameters correctly. Tim, I see. Tim, that's a good question. Can you please put that in the Q&A, and we'll cover that at the end. Some people put it in the chat. Those just a reminder questions need to go in the Q&A. I think Tamati's got one as well, so if that can go in the Q&A. So I'm going to just quickly just brush over this. I'm conscious of the time, and actually the Q&A is where you can ask some more questions. But really simply, and I touched on it before, when you're a buy and hold investor, you pay significantly less tax than a trader. How it works is like this. If I buy, so New Zealand has an intention-based regime when it comes to property tax, traditionally pretty easy to apply. Your intention when you purchase a property will dictate how it's taxed. Put pretty simply, if I go out and I intend to buy a buy and hold property, um, I am going to hold that for the long term. I'm going to add value. I'm going to put some tenants in there, and I'm going to hold on. In that scenario, I'm not subject to GST, provided that I wait more than 2 years to sell the property. I won't pay any tax on the capital gain. All I have to do in that interim between buying it, tenanting, and holding it is pay tax on any cash flows on an annual basis. So that'd be your net rents. But it's a pretty minimal amount of tax drag. Uh, People say to me, well, sorry, just to cover off the other side before I cover this off, if you are trading property that is active, it is very much more akin to a business than anything else in property. You will pay GST on the sale, and you will pay income tax on the net proceeds. You do get to claim GST in most cases when you purchase a property, and that can be super helpful because you can use those GST funds to pay for painters and landscapers and all sorts of things. So you have access to a little bit extra cash flow, but it is a double-edged sword. All things being equal, especially if you're working with a gym, you're going to make a gain. So 15% of that gain is going to go to GST, and then the balance of that is going to be income taxed. People often go to me on the trade side and say, well, why can't we treat it as just pretend that we're going to buy and hold it and then change our mind? I mean, the reality is you might be able to get away with that one time, but when Inland Revenue look at these things, it's pretty simple and clear for them to see, because if I buy a trade property, and you'll know this if you decide to talk to our mortgage team after this, the way you finance that property will be very different to the way that you finance a buy and hold. It will be main bank versus maybe a second tier lender. It'll be short term versus long term, and then also they look at your actions. Did you actually tenant it? Did you try? The bright line test is just something that's kind of muddly in the middle. Um, we have an intention-based regime to begin with. Your intention when you purchase it dictates how it's taxed, but then we have the bright line over the top. Regardless of an intention to hold, if you sell within the bright line period, which is just a line in the sand, 2 years currently, you will pay tax regardless of intention. To be clear, it doesn't apply to trading. If you trade properties, bright line doesn't exist. You can't hold a trade property for more than 2 years and avoid tax. And to be honest, if you did that, your margins be dead. Cool. Carry on. GST, I just went through that quickly. I don't know if you see any issues with your clients in this space, Jim, but for me, GST is the main risk that property traders who aren't well informed or don't have the right professionals get into trouble. We have compulsory zero rating in New Zealand, which means that if you have a GST vendor, GST registered vendor, and a GST registered purchaser, the GST liability passes through. As a property trader, in all cases, you want to be purchasing from a non-GST registered person. That will allow you to claim GST on the purchase, use those funds, and then pay out that other end. If you claim on a zero rated basis, 15% of your margin will be totaled the day that you settle, and that's not going to meet Jim's requirements for 20%. What happens is you carry the GST liability through, so you don't get to claim, but you still have to pay out the other end. Very, very easy to avoid that. Right at the top of the sale and purchase agreement is a little sentence that says, is the vendor GST registered for income for GST purposes? Yes, no. That should be circled in every single case. If it is no, move along, you can claim. If it is yes, you have a problem. It's not insurmountable. Um, you might already know, and the price has been reflected on the fact that you can't claim GST, or you can go back and negotiate with the vendor because they won't have to pay if you're GST registered. So there'll be plenty of wriggle room there. Go negotiate. The important thing is that you get the opportunity to do it. I unfortunately see this far too much in a year where a client hasn't sent the sale and purchase agreement to me or maybe Jim or his team. Get other eyes on it. It takes about 2 minutes for me to look at it and tell you whether you're okay or not. So just be very careful with GST.
Yeah, we
So you,
actually put a standard clause in place now in all of our sale and purchase agreements that actually your team helped to craft to deal
oh,
with that.
perfect.
Yeah.
Yeah. Yeah. And it's a nightmare because it really kills the margin. And I've seen like lawyers, we've had clients who are lawyers make the mistake. So it can happen to anyone. And if you're our client, I like to see every single sale and purchase agreement. It takes me literally 1 minute to have a look at it and see if it's okay.
Yeah.
Cool. Structuring options. We'll just quickly roll through this and then we'll get into the Q&A. I'm not going to do this extensively, but what I do want to do is just make you aware of the different types of structures that are available for the different types of property activities that you will be undertaking. If we're looking at trading property, nearly always that would be done by a limited liability company. That would provide you a couple of things: separate legal entity, professionalism, which I'm a huge believer in it. And when Jim said it earlier in the thing, I just love it. The third thing is limited liability. Every now and then things do go wrong, and property trades sometimes can end up in situations where you have to sell for less than your costs. And GST is something that you have to repay. If you have a limited liability company and you haven't done anything that you shouldn't have with the money, you can walk away from things like GST debts relatively easily. So they provide little bit of protection from that kind of thing. Also, downstream liability, which is basically if someone comes back around later and tries to sue you for something you didn't know about. With companies, once you've done a few trades, you can wind them up. They cease to exist and it becomes pretty hard to reinstate them. If you're looking on the buy and hold side, trusts are often used for positive yield properties. So those are properties that pay you money on a weekly or monthly basis. They provide a high level of asset protection, professionalism, and the ability to distribute income to beneficiaries one over another. So you can look for effective tax rates that are lower than maybe yours, or a look-through company, which would be commonly used for passive investments that were negative yield. Key difference is with a look-through company is that it's just fiscal transparent. It flows out automatically. So you have very little control of that. But if it's losses, it's not something you're going to worry about, but you still get the benefit of limited liability, separate legal entity, etc. One final thing, if you go on to be a very active and successful trader, quite commonly we would see trust structures at the top of that and the trading companies all falling below. So those are some of the things, I guess, from my point of view. Matching the right structure to your investment goals and your activity is important. Um, it's important to consider that structures might have to change over time as well. And then also every now and then structures can impact your lending um, and or tax decisions. With lending, you do need to be careful if you're going to have people in those structures that don't work or are past an age that the bank considers to be palatable. You might run into trouble. So with all this stuff, ask the questions. And I think on the very last slide, I've just put it's I wanted to get this in this there because this is something that we're seeing a lot at the moment. And I thought that maybe if anyone was on this and it was their situation, then it might be helpful. So the Kiwi dream, as I used to call it, which I think is almost dead in property, but I call it like this, Jim. You buy your first house, you add some value, then you go, cool, I'm gonna leave that as my first investment property. I'm gonna buy my next house, and this is the house is a bit bigger, and maybe I'm gonna have my kids there. Um, And then if I'm doing really, really well, maybe I'll get a beach house as well. And then then I'll go to my final house, and that's going to be the big one. Maybe it's a lifestyle block, and that's the Kiwi dream. With the way the property prices have gone in the last 10 years, it definitely is getting increasingly difficult to go the full way through the dream. But what I do see a lot in my office is people who leave their own occupied house as an investment and buy a new house to live in. Sometimes that's a great idea. Sometimes it's driven by nostalgia, which is, maybe it's not the best investment. Or sometimes it's just driven by the market, how the market is. Maybe they will get a better result if they rent it for 2 years and then sell it. This opens up a very good opportunity for debt restructuring. So in this example on the screen, the owner occupier property. Let's just say that it's your current own occupied property. You bought it for 500, you added some value, then the market's gone up, it's now worth 1 million. But you have a mortgage of 600,000, for example. I'm not following this example if anyone's trying to follow, I'm just doing one. Then you decide to buy your new house. Your new house is going to cost you 1.5 million. And you're going to leverage against your former own occupied. So that's the when you take the funds against the equity in that property. Now, if we did nothing else and you bought this new property, you would have a tax ineffective structure because you would have minimum mortgage against your old own occupied house, your new investment, and you would have maximum mortgage on your new owner occupied property, which is non-deductible. Very common and very easy restructure that we do is we take that former owner occupied property into a new structure at $1 million. We borrow $1 million from the bank and we reduce the mortgage on your new owner occupied property down to 500 in that example that was used. You end up with the same two properties, the same two mortgages, except that you get far higher tax deductibility and you get a professional structure to hold your investment property in. So everyone wins. You're already at the mortgage broker and or the bank. You're already at the lawyer. It's not that many more steps to do this. So if this is so anyone on this call and you've got a former own occupied property that's an investment, it's got low debt, but your own house has high debt on it, do get in touch. Cool. I think that gets us nicely to the end. So it's a couple of QR codes here. You can talk to the accounting team basically about anything that we discussed here from a tax perspective. If there's other things that you want to discuss, we can put you on to other places in the business, such as financial advice, mortgages, etc. And then there's the QR code for Jim. You can talk to him about his education framework, and I think you can probably tell from this webinar that he has a huge amount of knowledge, and he doesn't just go about this in an unordered way. There is a system and a structure that they apply to make sure that their members get the success that they're looking for. Do you want to add anything on that, Jim, before we go to the Q&A?
I also put in a free training in the chat there, team. So, you're more than welcome to go through that. It'll give you an insight into the aspects of your business that you'd need in place, and then also you can identify what would you need and where are your gaps. So you guys can go ahead and get that as well. But yeah, we're here to help as many people who want to shift gears, particularly in property. That's what we're here to do.
Yeah, I love that. And I think, it can be very difficult in this complex, modern world, and also where when markets have been the way they are to take that first step. And I think if you watch this and you want to take some action, the first step is just to book a call and have a chat. Um, just do something, you never know where it will lead. So there's a few Q&As. What I might do, Jim, is read them out and we can answer them. So Calvin has asked, how do you find off-market opportunities to avoid competition?
You've almost answered it in the question. If it's off market,
Yeah.
you won't have competition. So this is the thing. True off market is not the same as what an agent sends you. Okay, if an
Mm,
agent is sending you an opportunity saying, "Hey, I've got an off market deal," they're also sending that to the 50 other people on their list, or 100 or 200 or 5,000. Okay, so that's not a true off market. Just because it's not listed online does not I don't call it an off market
Oh,
deal.
yeah, sorry. No, he said, how do you find them?
Yes. So what I want to do first is define what an off market is. True off market is a property that's not on the market at all, meaning an agent doesn't even know about it.
Yep.
Okay. So the best way to do that is what I described earlier in terms of understand what streets are the best streets and then just go walk the dog or go for a walk with your family. Just go and enjoy nature, but at the same time pay attention to properties with problems. When you identify those properties with problems, well, now you've got an opportunity. The opportunity is to find out who owns that property, maybe leave a letter in the letterbox. If it's, clearly there's squatters in there, or no one's lived in there for years, leaving the letter in the mailbox probably won't get to them. But you can look up using certain tools. So the likes of Relab, the likes of Cotality, Property Guru. There's different tools that you can use. Most of those are paid platforms to get that information, but you find out who owns the property and then do many of you have your investigator hat that you can put on. Go and find them on the internet somewhere, all right, and reach out to them. I literally did that with the property we're under contract at the moment with, right? Not on the market. I found out who owned it. I then messaged him on LinkedIn and he replied. And so now we're under contract. So
Yep.
that's how, like in simple terms, it's the streets that make sense, then go and actually physically go and find the properties, and then physically go and reach out to the person who owns it.
Yeah, and I've even had clients who've done mail drops in the suburb they want to go to. So there's lots of good ways. That was a good one. Let's keep this moving. So there's another one here. What does overscoping the reno mean? Is that like when I overdo on things and don't add value to the property?
Yeah.
Pretty
Yeah.
much.
It is. It is. It's if you're not well, actually, Matt, you spoke to it earlier, which was if you're catering to your desires, then you're probably going to overscope the deal. You've got to just pay attention to what does the market actually want and need, and once you understand that, you're only going to provide that. You're not going to provide a whole bunch of other features and things that you think need, like the gold toilet or whatever, that doesn't need the gold toilet. Okay. So
Yeah.
yes, overscoping is a pretty it's pretty logical when you think about it through that lens.
Yeah. Yeah, I agree. And easy to do. So it's just about understanding and then making sure that you check your numbers. And if they don't make sense, don't do it. This one's a good one. Tatiana has asked, how can you trust tradespeople? They sometimes do not turn up or try to rip you off. Yes, sometimes. Jim, do you have any practical ways that you can check how you approach finding the right tradespeople? Because I think
Yeah,
it is
yeah.
important.
Yeah, so like everything, we have frameworks and procedures for everything. So this is no different. Yes, is the answer. You will have times where they're not reliable, they don't show up, that sort of thing. The best way we've found to deal with that is through recommendations more than anything. So if you're getting recommended the person, so not your, you know, auntie's cousin kid, like no, that's not the
Yeah.
one. Just because they say they can paint, don't go get them in, because yes, you will be behind on your project and probably do the worst job and all of that. So again, I've been through that experience myself, which is why I can speak to don't do that. But get recommendations from those who are in the game, who have the track record. So quite often, you can do that through real estate agents where they've utilized people over and over again, and so they know who show up, they know who have good pricing. But then other traders, other developers, that sort of thing, just start talking and sharing with people what you're actually looking to do. And then once you do that, they will share with you, hey, I know someone who's really good at these things. And then you can vet them as well. So I have a process that I take them through to vet who it is that you're working with.
Hmm.
To There's like key indicators that will tell you whether or not they're going to show up. So quick one, so we can move on to other ones, is if you ask them for, when can you show up to the property? Or if you ask them, can you give me a call at 5 o'clock? If you don't get the call at 5 o'clock, that's an indication that they're not doing what they say they'll do. Okay, so they're like, same thing with showing up on time somewhere. So little simple things, if people show you an early sign that they don't do what they say they're going to do, you can, yeah, often move on. And then we look
That
at three. We try and get three separate quotes. So that when we're building our team, at least once we've got our team, it's not necessary. But yeah, that's how we
yeah.
approach it.
Hey, and I really like that one. Set an appointment, and if they keep it, then you can deal with them. Because it's like if I set an appointment, if you set an appointment with me and I don't show up to it, what are you going to think? So I think that makes a lot of sense. Ollie's got a good question. Long-term buyers tend to beat traders at auctions and tenders. Is this due to traders' higher cost structure? Um, GST and immediate margin. If you both trade and hold, how can this dynamic be used to one's advantage? I think it's a great question, and I'll start a little bit on it, then I'll pass it over to you, Jim. But yeah, obviously, when a buy and hold investor buys a property, their lens is just so much longer than yours, um, and so they'll be willing to pay more based on a rate of return over a long period of time. But actually, I think what happens more in the buy and hold market is people get more emotional about it than they should, whereas a trader has done the numbers, and once you pass a number that doesn't work, you can't buy it. Whereas a buy and hold person can still buy that property even if it's overpriced, because the market will fix that wrong for them over time. In terms of using that to your advantage, I'm not sure about the answer to that, so I'll pass it over to Jim, see if he knows.
Yeah.
Don't buy it, just let them take it and find another property.
Yeah. Ollie, my man, Ollie's one of our members. He's very
Yeah.
astute and very strategic. So great question that you're asking, Ollie. Um, and part of it is in the way I view it is in how Matthew just described it, is what lens you're looking through is the important part. Um, and you can switch lenses, meaning you can look at it from a trade, and if you go, yeah, this isn't quite fitting the criteria, then put on the investor hat and go, what would it look like as an investment? That's where the strategic dynamic comes into it, because you can go, well, it doesn't work as a trade necessarily, but it does work as a hold. Why? Because it might be in a fantastic location. All right. So it might be somewhere where you've got strong uh, reason to believe that that area is going to continue to increase in value, and it's got strong demand for the rental side of things, but particularly from the capital gain, capital appreciation side. So I recently had this happen where we bought a property. It did not stack up as a trade. It just wasn't in the right location as a particular trade. It was in a very high-end area where there's just not the volume of turnover in that area, but it worked fantastic for a long-term hold. So it was changing the lens or the hat, whatever you want to call it, and running the numbers based on that lens. Once you've got clarity on that, then you can make a decision from there. But it's interesting you mentioned investors. It's also developers. All right. So as a trader, you've got competition like developers that you're going against. They
Mm.
also will pay a lot higher than what a trader would pay. So there's different dynamics that are at play. But my general rule, just going back to that, is that if you weren't like if the numbers didn't stack up for whatever it sold for, it was never a deal. So you
Yeah.
missed out on nothing. You didn't miss a deal.
Yep.
The flip side is if there's an auction, and I see this happen, from time to time, where there's an auction, uh, and you would have paid that, and you didn't show up to the auction, or you thought it was going to go for more. That's where you miss a deal.
Yep. And also you miss 100% of the deals that you don't put a sale and purchase agreement
Yes.
on. I always say you can't buy a property if you didn't put a sale and purchase agreement, but you can always back out of a sale and purchase agreement, provided you're not at auction. So you might as well
Yeah.
have a go. Quick GST one, which I think we might have covered anyway. Does zero rating for GST only apply to property trading or also on buy and hold? I thought I'd just quickly answer this. So buy and hold properties are exempt from GST. You do not need to worry about it unless you get into a really niche area, which is short-term accommodations or hotels, motels, or boarding houses. If it is normal buy and hold, no GST. Next one, I think we also covered when buying a property, doesn't make a difference if you buy as an individual, company, or family trust. Um, it does. It will depend on what you need in terms of asset protection, what the yield of the property is, positive, negative, and what your family situation is. It's very specific, but it does matter. So make sure you talk to someone. Um, Tim, this is a bank one from Tim. Do banks still lend against your equity if they know the funds will be used for a house flip? Question mark. I'm also thinking about the impact of a mortgage break fees and whether using JV investors might be a better option. Could you cover that as well? So maybe I'll start with the mortgage part and you can do the JV part, Jim.
Mhm.
In short, yes, the banks will. There's a number of different ways that we go about it. Sometimes we have to go to a second tier lender. There's two ways that can be done. One, we can just draw the equity out of your house, take that separate loan that forms the deposit of the trade, and then the second tier funder will fund the balance. Or in some circumstances, we have to take the whole house in, which is a little more complicated. We try to avoid that, but in short, do banks still lend against you equity if they know it's for flipping? Yes, they do, provided that you have a robust loan to value ratio and you can afford the servicing. JV investors might be a better option. Obviously, the hat says it all. If you can get other people's money, OPM, that there can be benefits, but there's also costs. Usually, that comes at a higher cost than a bank. But Jim, I'll pass it over to you for that.
Yeah, yeah. So one thing on what you mentioned as well, I think it's important to highlight is if the non-bank lender, let's say, takes the full mortgage of the home, you're going to be paying a lot more because now
Mm,
you're paying
yeah,
fees on the entire loan. So just be aware of that when you're considering this. Quite often, like strategically, it's better to get a top up rather than
yeah,
refinancing the entire thing. A lot of people sort of don't pay attention to that. Typically, a mortgage broker is going to just say, what do you want to do, and then provide you with the options. But check that as an option as well, because you'll save a heck of a lot on fees. The part in which, like, where does it make sense for a JV? Well, it depends on your structure. If you're looking at a JV, like a true JV, typically you're giving up a lot. Okay, so a JV is typically about 50-50, depending on what the dynamic is. I generally talk about it in a very clear way when it comes to a JV, where I say there are two main components to doing a deal, which is money and time, knowledge, expertise. All right, or yeah, the actual doing all the work. The that split would be a 50-50 split if the money partner is putting in all the money, okay, and then doing nothing else. And then the time partner is putting in like getting the deal, running the project, getting it completed, getting it sold. They're managing the entire process. That's the way I think about a 50-50 JV. Um, Now, as you become better at it, you can negotiate better terms. So as you build your portfolio or your business in property trading, then you can get better deals on your funding. So that's where you might get private investors that instead of giving up half of your profits, you're giving them a return on their money. So often it's very close to what a non-bank lender would be, but without the fees. So if you can get private lenders, it's even better than non-bank lenders.
yeah, because you can avoid legal and all sorts of stuff, can't you?
Yeah.
That was good answer, thank you. So we'll keep moving through this, conscious of time. So How does trading not apply to the bright line? That's easy. So bright line is only applies to buy and hold properties. If you trade properties, your intention when you purchase the property is to sell it in the short term. So any gain is always taxable. Rod has asked, is there a real estate agency that you've found better, or is it similar to knowing the local area, as in who is the best agent for the local area? I think you're going to say it's find the best agent in your area. Um, yeah,
Yeah,
and
nothing more
no,
to it.
yeah. All real estate firms can be good and bad, and they can have good and bad agents. Find the right agent, and you won't have a problem. Next one, how to work around 10 years tainting. I'll try answer that very quickly. So tainting only occurs if you're a dealer, a developer, or trader in land, so a property trader, for example, and you also buy and hold properties at the same time. Easiest way to avoid it is when you're trading properties, don't buy any buy and hold properties because it doesn't apply to anything you already owned and it doesn't apply to anything you buy after. So stay in your lane. Don't mix the two streams, and you'll be fine. If you want a better answer or more nuanced, you're going to have to book in for a call for that one.
Good
Um,
answer.
yeah, this one's a good one. This is the final question, and then we'll say goodnight to everyone. What strategy can I use in 2026? Wow. I think that depends on what you want to achieve. Buy and hold or trade are both great strategies if you're doing them for the right reasons. So,
Hmm.
Jim, do you want to give us the elevator pitch for the trade? And I'll do buy and hold and we'll sign off.
Yeah, no, I mean, exactly that. What's your goal? If your goal is to replace your income in a very short period of time and then like commit to property, then property trading is a great way to do it. It's the fastest way I've seen to be able to do it. You're not going to be able to achieve the freedom from your workplace or what have you, uh, if it's a buy and hold strategy because it's long term. You're looking 10, 20, 30-year strategy,
Yeah,
which is again where we go back to the triangle. It's the multiply is the way that I think about it. So any free cash from your business or your day job, that sort of stuff that's going towards investments, I would then have property investments as part of that strategy. So again, it's just what is the problem you're looking to solve in your life right now? What's the goal? And then what are your pathways? What are the pathways to achieve that? And then choose which pathway makes the most sense. And then, my bias recommendation is get educated, right? Even if it's not from us, get around people who already know the stuff, because the mistakes you make in property have a massive effect. Like it's not worth not getting the right information and strategy and guidance and that sort of thing. It'll save you a lot, not only money, but also time, right? And unfortunately, you can't get time back. So that's the way I always approach when we're thinking about what pathway, and then how do I best go about that pathway. I'm always looking for, right, who's the expert? Who can I who can see around the corner is the theme that I talk about often these days is I want to be around the people that can see around the corner.
yeah, great answer. I agree with your sentiment. What you're trying to achieve becomes really important. Trading is a great way to make money. What happens for a lot of people is they fall in love with the process because we mentioned earlier that feeling you get when you add value and it's very tangible property. You can see it on the street. Um, and then somewhere along the line, if you want to replace your job, that's really good. If you want to grow long-term wealth, well, that's when you have to start going, well, I'm going to take some trading money, I'm going to build up a big pot, and then I'm going to start to buy some buy and hold investments, for example. And I think I see it a lot used when people have built a portfolio already and they run out of servicing, so they can't borrow any more money. They'll go out and do trades for a couple of years. They'll pay down a lot of debt, then they'll go back to buy and holds. I've seen it where people just don't have the deposit to do a meaningful buy and hold portfolio, so they'll trade to get their deposits up. And then I've just seen people who just want to quit their job. So I guess the key thing is make sure that you understand your plan. Jim's point around education, 100%. This We have lots of it that we give away. The internet has lots of it. YouTube, go get it. And agree with property. The great thing about property, it's a big widget. When it goes well, it can go really, really well, and it can be life-changing. But when it goes bad, it can go really, really bad. So you've just got to be really careful with it. I think this has been a great webinar. Thank you very much, Jim, for coming on and sharing your knowledge. You've definitely got me thinking about going out and doing a trade.
Thank
Um,
you.
yeah, and thanks to everyone who tuned in. I can see that there's still quite a lot of you still watching, so appreciate you staying to the end and enjoy the rest of your night.